Hey everyone, it's Phoebe, and welcome back to TradingKey. Lately, if you've been watching the tech giant Apple, you might feel like you're seeing double. As we moved into March 2026, Apple handed in a report card that feels completely split. If you only look at the hardware news, you'd think Apple is absolutely crushing it. On March 11, they released the MacBook Neo starting at just $599. Alongside the budget-friendly iPhone 17e. This aggressive pricing is a clear signal that Apple wants to trigger a massive upgrade cycle and grab market share. But here's the catch. While the hardware is flying, Wall Street is feeling a distinct chill. Apple's stock price has been under pressure and swinging wildly. Mark Gurman revealed in early March that Apple has hit a major bottleneck in its AI development. This struggle didn't just mess up the latest iOS 26.4 update, it even delayed the much-anticipated HomePad Smart Display, codenamed J490, all the way to September. With hardware sprinting ahead and AI software lagging behind, many are asking, is Apple actually finished in the AI era? Today, we're going to ignore the short-term rumors and look at their financial strategy to see what Apple is actually planning. This is much juicier than you might think, so don't miss out on this. Before we dive in, just a quick reminder that this is for research and sharing purposes and does not constitute investment advice. Understanding the logic is always more important than the trade itself. Why Apple won't chase the cloud. Microsoft and Google are in a brutal war for cloud supremacy. And since Apple is sitting on the sidelines, people assume they just don't have the technical DNA to compete. But Apple's reasoning is actually very cold and calculated. First, the barrier to entry for AI tech is dropping fast. Think of it like a top student pulling an all-nighter to solve a challenging math problem, only for everyone else to copy the solution the next morning. In the AI world, this is called model distillation. It allows latecomers to catch up much more easily. Inevitably, cloud AI is becoming a space where it's hard to maintain a long-term lead just by having a bigger model. Second, the cost for a user to switch cloud products is incredibly low. Loyalty only lasts as long as your model is the best. For instance, when Gemini caught up in 2025, ChatGPT's traffic share dropped from 82 to 68% in a single year. Without an ecosystem to lock them in, users will abandon you the second a better tool comes along. But the real killer is hidden in the financial reports. Let's take a look at the projected capital expenditures for 2026. Altogether, these four giants are going to burn over $600 billion this year on data centers and chips. Which goes without saying that cloud AI is becoming a black hole for cash. And Apple? They are only expected to spend $14.3 billion, a tiny 3% of their revenue. Naysayers claim Apple is losing by paying Google for Gemini, but it's actually a brilliant business move. Paying an API fee is way cheaper than building a $100 billion infrastructure. In fact, the fees Apple pays might not even cover the electricity and hardware depreciation Google faces to handle all those iPhone requests. In the long run, Apple might even start charging AI companies for access to its 2 billion active device users, just like Google pays Apple $20 billion a year today just to be the default search engine. Making the customer pay for the AI? Apple is betting everything on the on-device AI, which refers to running models directly on your phone, because it gives them total control over profit margins. Because here's the detail most people might miss. The biggest cost of AI isn't training, it's running the thing itself. In the industry, we call this the inference cost, and it accounts for up to 80% of total expenses. Training a massive cloud model costs hundreds of millions in computing power. Meanwhile, training a smaller model for a phone costs somewhere between $100,000 and a few $1,000,000. They aren't even in the same ballpark. Apple's strategy is a masterpiece of cost shifting. By running the AI on the phone, they move the massive workload and the electricity bill onto the chip and battery that you already paid for. For Apple, the daily cost of running that AI is essentially zero. You bought the phone, you pay for the charging, and your hardware does the work for them. So even if their own model is delayed, it isn't a death blow. They can use third-party solutions for now and swap them out later. Since third-party models will never be as optimized for Apple's unified memory and NPU as their own, the switch will be seamless when they are ready. Why is the stock still shaking? If the logic is so perfect, why is the stock price still struggling? This comes down to what Wall Street calls the second derivative logic. Basically, the delay of the HomePad and the full Siri update has messed up the big supercycle story. Investment banks were predicting that AI features would force about 300 million people with old iPhones to finally upgrade. Morgan Stanley estimated this would push iPhone sales to 262 million units in 2026, about a 10% jump. That might not sound like much, but it means growth would go from 0 to over 10%. That change in speed is what justifies a higher stock valuation. Since the AI features are delayed, that revenue gets pushed back too, which causes short-term panic for investors. People who were hoping for an AI-fueled payday in March now have to wait until September or even next year. However, the demand to upgrade hasn't disappeared, it's just been postponed. Apple has a massive strategic buffer because of its ecosystem. They don't need to fight in the mud with the other giants over computing power. They can just wait, stay in their lane, and eventually collect the profit. A solid foundation. To wrap it up, Apple's recent setbacks are definitely frustrating in the short term. But as long as the user base stays loyal, their low-burn financial strategy is incredibly resilient. This isn't just about a news headline. It's a lesson in understanding how the big players actually make money. Seeing the difference between companies burning cash and Apple shifting costs to the consumer is the key to staying calm during market volatility. So, what do you think? Will Apple's plan to skip the cloud war actually work out? Or is this delay giving Android competitors a chance to steal the lead? Let me know your thoughts in the comments down below. Thanks for joining me today. If you found this video helpful, remember to subscribe to TradingKey, give this video a like, and share it with a friend who might just benefit from learning this too. With that, I'll see you in the next one.